I am CA Megha Agarwal, the moderator of this webinar. We are delighted to welcome you all in the webinar being organized by Continuing Professional Education Committee of ICAI. It is my pleasure to be a moderator for the webinar on GST refunds and errors under Payments of Export IGST refund and digital economy taxation. In a short while, we will start this webinar. First, I would like to apprise you about the CPE committee. The role of chartered accountant is evolving continuously to accept newer responsibilities in a dynamic global environment. The future of CA profession depends on being flexible and open to innovation. Therefore, the need of the hour is to innovate as per the requisites of the contemporary business environment and accordingly upgrade the curriculum and education system of chartered accountancy course. Now, without taking up more time, let's move on to the program for this evening. We have two sessions of 1 hour each, and topics are GST refund, restrictions vis-a-vis choosing correct method, decoding the errors under with payment of IGST refunds, IGST exports refund, and the second is digital economy taxation. Our eminent speakers will talk about the above mentioned two emerging areas of professional interest. Okay, our first speaker will be CA Deep Ramesh Koradia. He has the experience of more than a decade in the field of indirect taxation. He has contributed in designing syllabus of new CA course for the subject digital ecosystem and control and audit. He has also delivered various lectures about GST on multiple platforms. Please welcome our first speaker. Sir, our first speaker.
Yes,
Hmm.
thank you, Mega, for wonderful introduction. Uh, Today we are. Let me share my screen first. Okay, thank you, Mega. Uh, Respected Chairman of the CP Committee, Sri Purushottam Khandelwal ji, respected Vice Chairperson Gyanchand Mishra ji, other members of the committee, all the participants, senior members of the profession, professional brothers and sisters. Today we are in first hour we are going to take a topic issues under GST refund, and basically we are going to address two questions. The first one being restriction under both of the methods. So there are basically two methods to export your goods outside India. The one is with payment of IGST, and another one is without payment of IGST, that is under LUT. So there are set of restrictions under both of the methods. When the GST was introduced in way back in 2017, these complications were not there at this extent. Currently, when the day passes and the law gets evolved, the restriction with respect to both of these methods has been increased, and there are set of restrictions for LUT method which may not be there for with payment of IGST of export method, and there are similarly there are set of restriction for with payment of IGST exports method. So before choosing any of the method, one need to averse with the knowledge of whether he or his client are hit with any of the restrictions. So that is a very crucial part. And basically we our practice is being uh, can be categorized in three different part: consulting, compliance and litigation. So particularly this thing falls under the category of consulting, wherein the role of a consultant or a chartered accountant comes into play even well before the transaction has been entered by the taxpayer or an exporter. So that is a very sensitive issue. If we are doing a compliance part, if you are doing annual health check or annual audit, and if you came to know at the time of annual filings, or even if you are doing a monthly compliance work, and if you come to know about the issue at the after the end of the month, and that will be very costly to recover, or that will be very with headaches to correct or cure such mistakes. So it is very advisable to have knowledge about the restrictions and to choose the correct method, which will help exporter to have a smoother compliance. And our today's second topic would be the journey of with payment of IGST refund, from starting from filing of shipping bill to traveling of such invoices from DG systems data, from GSTN to IceGate, and ultimately it will travel to the PFMS, and at the end the amount has been credited in the bank account. As such, the procedure is totally automated, but since it's being driven by the computer, so one needs to be very vigilant and careful while submitting their shipping bill, or while filing their GST returns. So basically, these different two topic will discuss today. With on this note, let's start with today's two topics. So there are, see, that is now very clear position that unlike in the VAT era in many of the states, refund could have been filed in annual return as well. So that thing has been gone now. Refund has to be filed separately, and there are so many types of refund which has been listed over here. And I'm sure this PPT will help all the participant to go through all such details which has been given in the PPT. So there are so many types of refund. Out of that, today we are concerned with export of goods that is also outside India, and two methods of export of goods outside India and restriction thereof. So moving forward, I have also listed the exhaustive thing related to refund under GST, GST Act, CGST and IGST Act, along with rules, circular notifications, and instructions that has been listed over here. I'm sure this will help participants. So moving forward and coming back to our first topic. So before starting with seeing the restriction of both of the method, recently Section 16 of the IGST Act has been amended. As such, this amendment has been done in Finance Act of 2021, but made effective with effect from 1st October 2023, after 2 years or so. So basically, in broader terms, there are three major changes has been found in this definition of zero rated supply. The first one is being, if anything has been supplied to SEZ developer or SEZ unit, that has to be for the authorized operation, then only it will be called as zero rated supply. Zero rated supply in common parlance we used to speak as an exports, but in GST it has been defined as zero rated supply. So if anything supplied to SEZ without considering it as an authorized operation, then it won't be now classified as a zero supply. This thing has been already there in the rules while applying for the refund. Now the law has been made in sync with the rules. The second change which has been made in Section 16, that is with respect to receipt of export proceeds. So now the section itself provides with respect to the payment in foreign convertible currency has to be received within time limit stipulated in FEMA. And the third one, which relates to our today's topic, see, when GST law was introduced, we used to refer section 16 bracket 3 of IGST Act, which clearly was providing that exporter may choose any of the method to claim the refund, be it with payment of IGST or be it without payment of IGST, that is LUT. In case of with payment of IGST, exporter needs to pay the tax first by applying the rate of goods rate of by applying the rate of goods on the value, and coming and the whatsoever amount is derived, that has to be firstly paid, and then such amount is being credited as a refund. Such a refund has been an automated process from day one, and such a refund is being handled by the customs in DG systems. And secondly, and another method was uh, exporting the goods without payment of taxes under letter of undertaking and claiming the unutilized ITC pertains to such exports by applying for refund in RFD 01 form. So that was broadly two method has been prescribed in section 16. However, with effect from 1st October 2023, the government or the lawmaker has by default has given only one method, that is without payment of IGST under LUT. So by default there is only one method now. However, section 16 bracket 4 does give some power, and which says government will notify the class of person or class of goods or class of and class of services. Based on such positive list, a exporter may opt for with payment of IGST method as an export. So that is broadly the bluntly choosing of method between these two has been done away. Currently, however, the notification has been issued 01-2023 integrated text, wherein government as such government or the lawmaker has made the provision that they will give only positive list of goods, which goods or which class of person may opt for with payment of IGST. However, currently they have given a negative list. Basically, tobacco products and essential oils has been listed over there. So other than these two or three list of set of products, currently the exporter may also choose with payment of IGST method. However, one should be very cautious and one should be very vigilant and watching and tracking this notification 01-2023 need to be track very diligently. Reason being, now CBIC can any point of time add or remove any of the product in the list, and if your client or the taxpayer is dealing with such a product, and so by default he will be restricted from opting for with payment of IGST refunds method. So that is one of the crucial change which I wanted to highlight it. Now, the zero rated supply basically includes four things: export of goods, export of services, supply of goods to SEZ, and supply of services to SEZ. Out of that, today we are going to take export of goods out of India under both of the matter. We will see the comparative analysis. We see the restrictions. So with with uh, with payment of IGST route, has as I have already explained, the now positive list, they will give the positive list. They have given as such a negative list. The for and the product listed in such a negative list are now restricted under with payment of IGST method. They will also list class of person who can export under with payment of method. Currently, pan masala, tobacco, and essential oil, as I have been already explained, has been negatively restricted under this route. Such a list can be amended time to time, so one need to be very cautious. Now, what they've also done is at the time of filing the shipping bill, if say you prepared one invoice for 20 product to be exported out of India, out of 20 product, or say one product belongs to such category of restrictions, say pan masala, tobacco, or essential oils, as mentioned in notification 01-2023. So out of 20 product, even if one product will hit such restrictions, the DG systems itself, it will not allow you to file your shipping bill under with payment of IGST method. So that need to be taken care of till such systems change has been made. One need to be very cautious while filing the shipping bill and should not include such products under IG with payment of IGST route. Moving forward, Can a taxpayer use any of the export route with payment of IGST vis-a-vis without payment of IGST freely, interchangeably, anytime? The answer is big no. Why big no? See, if an exporter cannot use these two methods independently or freely or interchangeably anytime, so what is the answer? So which method is to be chosen by exporter? So there is no straightforward answer. That's why we are here to discuss the restrictions. So there is a decision making process even before entering into the transaction of exports. That is where our role comes into play as a consultant. So let's see the comparative analysis between these two methods. And believe me, the topic is one, but we are about to deal a dozen of provisions of the law with respect to both of these methods, with payment of IGST vis-a-vis without payment of LUT. Now the filing mechanism is simple. In case of with payment of IGST, your shipping bill rule 96 specifically provides your shipping bill itself an application. So as such, there is no requirement to file another refund application. But side by side, the one question is to be taken care of at these stages. At the time of filing of shipping bill, if any mistake has been made, if IGST amount has been written by forgetting one of the digit, or any other issue has been created at the time of filing of the shipping bill, then it will create a big issue. Reason, once the EGM has been filed, the amendment to shipping bill under section 149 of customs is only allowed in manual mode. So your amendment, if you come to know of any of the mistake in the shipping bill in case of with payment of IGST, and if you go to the Superintendent of Customs to amend your shipping bill, once the EGM has been filed, such correction cannot be done by the Superintendent of Customs in the system. So the automated refund process will affect. Your refund will affect. So that is why one need to be very cautious while filing the shipping bill. So shipping bill itself an application, and no separate application is required in case of with payment of IGST. However, in case of without payment of IGST, separate application is to be filed within 2 years. Separate application is to be filed within 2 years from the relevant date. In case of export of goods, the relevant date start as and when the goods crosses the Indian frontier, Indian border. So as such, application is to be filed separately, but the process under without payment of IGST is also online process, 100% online process. Who will process the refund? In case of with payment of IGST, the custom port and superintendent of custom and will be basically the refund will be processed by custom authorities. And in case of without payment of IGST, the jurisdictional officer will process your refund once you file the application in RFD 01. Okay, moving forward, quantum of refund. See, before introduction of so many restrictions which we are going to discuss in coming minutes, previously there was only in major measure particular, that is a quantum which was relevant to decide which method is to be followed, whether one should go for with payment of IGST or without payment IGST. So logic flows logically. If a refund is exceeded in with payment of IGST method, then one should go for with payment of IGST method. That was and otherwise under without payment of IGST method. In without payment of IGST method, the formula has been given in Rule 1894, wherein the export turnover's proportion to the aggregate total taxable turnover uh, is the proportion of is the proportion at that rate refund will be granted, to say it simply. However, uh, one thing at the time of calculating the refund amount, the in case one is opting for with payment of IGST, the ITC should be there to pay such amount. Otherwise, your working capital will get stuck. First, you need to pay such amount, then the refund will be created within once your shipping bill and scroll gets processed. So that was the mindset of we, the consultant, at the time of deciding any of the method. However, let's see the restrictions. So automation. So with payment of IGST is fully automated from the day one. However, for export of services, export of goods or service, export of services outside India, zero rate supply of services to SEZ unit, or export of goods to non-ADI ports is still under manual process, that is not automated. For that, even if you have chosen with payment of IGST method, one needs to file the application for refund. So moving forward, now coming to the restriction part. The very first restriction with respect to without payment of IGST is one cannot get the refund of capital goods ITC in without payment of IGST method. However, there is no such restriction in with payment of IGST method. So one can very well get the refund. So that is one of the key consideration while choosing the method. Now, secondly, inverted duty structure refund can be applied simultaneously. So in case of with payment of IGST, section 54 bracket 3, the third proviso to section 54 bracket 3 specifically restrict the refund of unutilized ITC if if the person has opted for with payment of IGST exports. So in case of with payment of IGST method or route has been chosen, the inverted duty structure cannot be applied. So say if you are a manufacturer procuring your goods at higher rate and exporting, and your final product falls under the classification of 5%, but you have ITC accumulation more than such amount, so you cannot simultaneously apply for inverted duty structure if you opted for with payment of IGST. However, there is no such restriction in case of without payment of IGST. So that is also a key consideration. Now, what if goods are subject to export duty? So second proviso to section 54 bracket 3 specifically restrict if you have chosen method of or route of without payment of IGST, that is a LUT, you can not export goods under such method, or if you exported, then you cannot apply for refund under LUT if your export products are leviable under export duty. So, however, there is no such restrictions in with payment of IGST method. Recently, a couple of months before, the government has introduced 20% of export duty on rice. Rice packed lesser than 25 kgs, pre-packaged and pre-labeled of 25 kgs or lesser packets are taxable. And if one has purchased such rice and opted for LUT route, then he or a taxpayer may not able to apply for the refund under without payment of IGST route under LUT route. So that should be taken care of. Uh, what if higher duty drawback in respect of central tax has been claimed? So section 54 bracket 3 do restrict without payment of IGST, that is LUT route, a person should not be given refund under with payment of IGST route if he has claimed the higher drawback in respect of central tax. Now, what do we mean by higher drawback? So, technically, drawback is a compensation for different levies which where the exporter has been paid. Now, for the first 3 months during the introduction of GST from the July 2017 to September 2017, there were two sets of drawback rate. One was lower rate of drawback, which does not include the refunds of central tax, and another is a higher rate of drawback, which will include the central tax portion. So if one has claimed the higher rate of drawback, then one may not be able to file the refund under LUT. However, after 1st October 2017, the government has done away with higher rate of duty drawback. So these thing this particular restriction is as of now redundant. Now moving forward, a very sensitive issue. The government or the lawmaker has restricted with payment of IGST route completely if any of these three benefit has been taken by the exporter. So what do we mean by completely restricted? Is it completely restricted? Yes, it's completely restricted. And believe me, there are lots of breach of these three things are being still going on, and we come across so many cases on every month with respect to breach of these three issues. So the government has introduced Rule 9610. Now, the Rule 9610 restricts if exporter has received the inputs under deemed export. So, what is deemed export? First, let's give 1 minute to the deemed export. One notification has been issued, notification number 48 2017 Central Tax, which says if an Indian taxpayer is supplying goods to the another Indian taxpayer who is ultimately an exporter. So, to 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 reduce the damage of the working capital, the supplier of the goods will issue will sell the goods to the Indian exporter under deemed export. And there are four types of deemed export which has been listed in this notification 40 2017. If the Indian exporter will invalidate his or her advance authorization license to the supplier and procures the goods against invalidation of such license, or invalidate the EPCG license, or the Indian exporter is an export oriented unit and receives such procurement against the benefit of such deemed export, or an Indian exporter is a private bank and taking the gold against advance authorization license. So these four categories are has been termed as deemed exports. That mind well, these deemed exports are different from 10 paisa sale, and these deemed exports are different from zero rated supplies. These deemed one should not get mixed these deemed export with regular export with regular zero rated supply. This is a different thing. However, if an exporter has taken the input on which the supplier has taken the benefit of deemed export, meaning thereby if the exporter has invalidated his advance authorization license or invalidated his EPC license, or exporter is an export oriented unit and taken the benefit of this notification, the the route of with payment of IGST has been completely blocked. The Rule 9610 starts with any person. So any person has received the supplies on which the supplier has taken the benefit of this deemed export, then he is being barred from taking with payment of IGST methods route while exporting his final products. The another restriction is if exporter has procured the goods under 10 paisa under the notification number 40-2017 central tax rate or 41 2017 integrated tax rate. So what is this 10 paisa? So they are commonly known as a supply to merchant exporter, wherein the Indian taxpayer supplies to the exporter under levying only 10 paisa as a tax instead of 18%, 12%, or 5% of rate, only token rate of 10 paisa. And the exporter ultimately exports such goods out of India. In such cases, exporter cannot opt for with payment of IGST method. So currently, if such things has been done, then system is very well sanctioning the refund. So if refunds are being credited in your bank account, that doesn't mean everything has been done correctly. One need to be very cautious. These things may not be traceable by the computer at the time when you are filing your shipping bill or you have uploaded the details in your GST R1 or 3B. So these things will be catch up on later on by the investigation authorities. So one should be very cautious. If they are procuring goods under 10 paisa or under deemed export, they are not allowed to choose the with payment of IGST method. And the third one, if exporter has himself taken the benefit of 78-2017 customs notification number or 79-2017 custom notification. See, basically these notifications is extended version of advance authorization or EPCG license or EOU procurements, wherein against such advance authorization license or EPCG license, one may import goods and one may skip to pay basic custom duties as well as IGST. So, if one has taken such benefit and imported goods under the benefit of such notification under the advance authorization or EPCG schemes, then one is not allowed to export under the route of with payment of IGST. However, for these three restrictions, one may opt for LUT route and one may apply for refund of unutilized ITC. However, there are also restrictions under Rule 18 and 4 and 4B with respect to quantum of refund. So these Rule 18 and 4 and 4B will definitely see in coming slides. So which are the restrictions and how your refund amount will affect. If your taxpayer or your client or your taxpayer has chosen any of has taken any of the benefit of these three things, he is definitely not allowed under with payment of IGST route. And even if he is applying for LUT method, the standard formula of Rule 18 and 4 will not apply to such refund, and Rule 18, 4 and 4B needs to be applied. Now, what exactly these 18, 4 and 4B will see in a bit. So, another restriction is can every each and every supply of goods and services be eligible for with payment of IGST, as we have discussed in our starting slides, that with effect from 1st October 2007 to 1st October 2023, the with payment of fruit has been restricted route, and currently pan masala, tobacco product, and certain essentials oil has been restricted. Other than that, other exporters currently can opt for with payment of IGST, but one need to be very cautious and track these notifications on a regular basis. However, there is if restrictions in case of without payment of IGST, if there is a refund of unutilized ITC for construction service as per the notification number 15-2017, then in such cases without payment of IGST refund is restricted over there. This notification has been recently amended favorably, and now the if such construction services consideration if includes land value, then only restriction is applicable. Otherwise, one is free to apply for the refund in case of even in case of construction services. Refund to be credited in which bank? So the bank in case of with payment of IGST, since such refunds are being processed by customs, the bank registered with the custom authorities, custom ports, EDI sections in such bank account, the refund will be credited. And vis-a-vis in case of without payment of IGST route, the bank registered with GSTN, and the bank has been chosen from the drop down at the time of filing RFD 01. In such bank account, refund will be credited. So what are the time limit? So as such, in case of with payment of IGST, shipping bill itself is an application for refund. So once you file your shipping bill, once you file your all the correct GSTR 3B and GSTR 1, and your shipping line will file export general manifest. Once all such filing is being done, all the matching will be done by the DG systems, the custom portal, and in case everything found in sync with each other, the refund will transmit to the PFMS and ultimately in your bank account. In case of with payment of without payment of IGST, that is refund of unutilized ITC under LUT method. Once you file your application within 2 years from the relevant date, within 60 days, all refund will be credited in your bank account or a deficiency memo will be issued. Now, what kind of error or rejection can find in both of the methods? So, in case of with payment of IGST, since the refund has been fully automated, fully done by the computers, and there are so many checks, and if any mistake has been done, then there are so many errors SB001 to SB006 and TB001 to TB0025. These error codes will be populated on customs portal, IceGate portal, and after correction of such error, we'll see in detail the flow of the refund of with payment of IGST along with the what such error denotes and how to solve such error. We'll see in our second topic. Moving forward, after correction of such errors, refund will be processed. In case of without payment of IGST, deficiency memo will be issued in DRC 03, and after correcting such issues, a new fresh application needs to be filed. In case of with payment of IGST, from where can one identify and found the errors? So the error can be found in these three from GSTIN or from IceGate or from respective ports website. So moving forward, um, uh, in case of three restriction which we have seen deemed procurement against deemed export, 10 paisa procurement, and importing goods against advance authorization, etc. license. In such cases, with payment route has been blocked, and in case of without payment of method, the refund is still restricted not to the full amount but to these amount. Now, the irony is, government will see why such restrictions are there in the first place. We'll first see why such restrictions are there in the first place. By example, say if you are procuring three products A, B, and C. A, B, and C, three products. If you are procuring, you are paying 18% on all of these products, and you are exporting at 150 product A and B, and you are selling domestic product at 150. So the normal formula will comes to the refund of 36 rupee. Now this is a regular example. Now we come to the example number two, wherein say if you have procured product A at by taking the benefit of notification number 40-2017, with such use of notification, your ITC has been reduced from 18 to 0.10 paisa, yani 0.01 rupee. So your ITC reduced to the total ITC, your ITC total ITC reduced to 36 rupee. If you have the rest of the example is exactly copy paste. If you have exported 300 rupees of sales and 150 rupees of your supply is domestic supply. So if you apply rule 18 in 4 formula bluntly on all of the ITC 36.1, if you apply your formula on all of the ITC, your refund amounts comes to the 24 rupee. However, if you see closely that you have exported product A and B only, and you have got the ITC of 18 rupees, ITC of 18 rupees, and ITC of 10 paisa. So as such, you have got the ITC of 18.1 rupee, but by applying the formula of rule 18 and 4, your refund amounts to rupees 24 rupee and some paisa. So this is the government don't want to give you the excess refund compared to the compared to the ITC you have received to procure such goods which you are ultimately exporting. So to restrict such refund, government has introduced the rule 88.4 and 4B. So this example has been kept over here just to show the reasoning behind why such restriction are being given in rule 88.4 and 4B and 4 and 4B. Now 88.4A talks about deemed export. In case of deemed export, ITC availed, the refund should be restricted to ITC availed for input and input service used in making such zero date supply. The reason being, you should done away with your formula of rule 80 and 4. You should bifurcate which input and which input services are in fact used in making such zero date supply, and only uh, only up to that actual usage your refund will be granted. Now the thing is, the motive behind these restriction can be understood. The government don't want to encash you the ITC pertains to other domestic transactions. But while introducing this Rule 18(4) and 4B, government has not given any blunt formula, just given the text or written that only input and input services used in making such zero supply will be given. Now, how to derive such refund is a nightmare. We'll also see the methodology, different methodology which we have worked upon. Another thing, another interpretation is also going on, that there is no still there is no restriction to use the formula of 18(4), as there is no overriding effect over there as well. So in my opinion, one should take caution before agreeing to such view. Now moving forward, 18(4)(b). 18(4)(b) talks about 10 paisa procurement, and 18(4) also talks about the procurement against advance authorization license, importing against license. In such cases, the refund is restricted to, again, the same logic, refund of such 10 paisa of ITC and other input and input services used in making such export of goods will be allowed as a refund. Even in third case, ITC availed for such notification and other input and input services used in such exports will be allowed. So that is what the refund is restricted, not available fully as per the formula, but to this extent. We have already discussed Rule 9610 in the table itself. One rider is there, if capital goods procured under EPCG license, then in Rule 9610, such a restriction will not be hitted, and one may opt for with payment of IGST route if only capital goods has been procured under EPCG license. Another thing is, if while importing the goods, only basic custom duties benefit has been taken and IGST has been paid fully at the time of filing bill of entry. Even in that case, these restriction of restricting the route of with payment of IGST will not be hitted, and one can very well export under these route. So moving forward now, why such restrictions? Why such restrictions, which we have already been taken by example? So what's the way out? We have seen that in case of Rule 18(4) and 4B, in the method of export under LUT, they have just given that the refund of input and input service to the extent used in zero date supply will be given. But practically, it is not feasible, it is not practicable to derive each and every inputs when something is produced in the factory and some stock has been kept in the factory, and the factory and such production unit is dealing with domestic supply, export under LUT, export under with payment of export, all of such and all such complicated transaction. The input and input service dedicatedly used in such exports may not be feasible to derive. So, the very first layout is invoice level segregation, which I have discussed is technically I have 100% strike rate with respect to failing in this invoice level segregation method. It is not practicable at the production level. Another one is FIFO. So whatsoever you have purchased in FIFO, first in first out method, if you are exporting such goods, then you need to check your stock registers, and on the FIFO basis, one may opt for which inputs and which input services are being used in manufacturing of the goods which are now being exported. Another another way out may be that if there are 20 raw materials in any of the production, and out of such 20 material, so one raw material is being imported against using of such advanced authorization license, then such ITC of such similar thing which procured domestically should be avoided, considering it as an such as the imported material has been used. So any such similar raw material procured locally will be deemed to be used in domestic supplies only. So that can also be done. Another methodology can be can be done on a license to license basis, wherein if in your shipping bill, if you are obligating for utilizing any license, then in particular such shipping bill, you need to follow Euro 18.4 and 4B, as you are yourself is declaring in the shipping bill that we have used some of the imported goods again license in exporting this particular goods. There are so many parameters. Pre-import conditions are now being done away. So if you have not imported such thing, but you are fulfilling your obligation well in advance, and you will import against such license later on. So how to deal with such situation? So each and every situation requires separate attention, and at each situation one need to take a call that he is in fact fulfilling the rule 18.4 and 18.4b while applying for the refund. We have seen the example. Now coming back to our second methodology, second topic of the session, with payment of IGST, the whole process flow. Now, technically, when the law was introduced, two set of consultant are concerned with this particular process, or two set of consultant are involved. First one is we, the chartered accountant or a tax consultant, and another one is custom agents. Since the since the filing of shipping bill is also needs some consideration, and the refund has been processed through custom authorities, we need to get in sync with our custom agent. If let's see the whole process of with payment of IGST method. The initiation will start at the time of shipping bill. So one should be very, as we have discussed, and I'm reiterating that one should be very cautious while filing the shipping bill. Shipping bill is the application for refund. The invoice number, invoice date, the product details, the invoice amount, IGST value has to be in sync with tax invoice. If there is any issue of dash and slash, say your CHA has by mistake used the backslash in your invoice number, but while filing your GSTR1 or preparing e-invoicing, you have used the front slash. The computer is very dumb thing. Computer will not recognize this clerical mistake, and it will raise an error and keep your invoice in abeyance till you rectify such error. We'll also see the rectification, how to do such a rectification, how to find such error, and how to do the rectification of such error in coming slides. But the prevention is better than cure. So what can be done is, at the time of filing of shipping bill, we should always take the shipping bill checklist from the custom agent, and we should always take the copy of tax invoice from the exporter, and we should check all such parameters which I have just discussed in shipping bill. Once it has been done, one should proceed with filing of shipping bill. Now, the another issue which has been solved, which has not been solved fully till date, but solved to great extent. People used to use commercial invoice number on the shipping bill, which the commercial invoice which they are going to deliver to their recipient situated outside India. However, after introduction of GST, now shipping bill is the primary document which is to be linked with your returns and your data of tax invoice as you file on your GSTN. So if your commercial invoice has been used while filing the shipping bill, which has some another series, and you are uploading your tax invoice in your GSTR returns, then it will definitely cause an issue, and your refund will get stuck. So it is highly advisable not to use the commercial invoice. IGST value should be entered on shipping bill. As I have discussed, invoice amount, IGST value, invoice number, date has to be issued, has to be written exactly in sync with your tax invoice. So once the shipping bill has been filed, then the role of our chartered accountants comes into play. At the time of the compliance part, GSTR1 should have invoice number, date, shipping bill number, shipping bill date, taxable value, IGST. All such things are to be in sync with your shipping bill. That is the key requirement. Once the GSTR1 has been filed, your invoice is still situated in GST and has not been traveled till you file your 3B. So the one of the very crucial thing while filing 3B is IGST amount, uh, which has been declared in GSTR1 has to be paid in table number 3.1B. These things, this is very sensitive matter. Reason being, people used to pay such tax in 3.1A. 3.1A of the GSTR 3B with is for domestic supplies. So if you paid in 3.1A, then GSTN will not consider as your export invoice has been paid, will not consider it as it has been paid, and your invoice will not travel out of the GSTN itself. Once these things has been taken care of, other authentication has to be done. Once these things are being done, your invoice now will be transmitted to IceGate. On IceGate, once the your invoice reaches to IceGate, the IceGate will already have your shipping bill data from the digi systems. When you have done with your GSTR 1 and 3B, your IceGate will also get your data from GSTN. And when your shipper file EGM, Export General Manifest, such EGM data will also be fetched to IceGate. When all such three things are being received by the IceGate and all such things are in sync, the shipping bill number you have entered in GSTR1 is in sync with the shipping bill filed by your custom agent, and EGM, all such things are in sync, your uh, invoice will get validated. If there is any error, then IceGate will reflect error from SB001 to SB006 or SB01001 to 104. If there is no error, it will reflect SB000, SB000, meaning thereby there is no error. Once SB000 validation has been done, then at 15 days or interval, IceGate will generate a scroll. What do we mean by scroll? Scroll is just a list of separate exporters whose invoice are being transmitted in last 1 or 2 weeks. And once such bunch gets ready, IceGate will generate the scroll. Once the scroll has been generated, your list has been transmitted to PFMS, Public Financial Management System. So over here, the if scroll has been generated, then the refund is bound to be coming to your bank account. The or technical error has been solved. Now the only error which may be there is validation of your bank account, which can be very well solved on PFMS or any ADI section of custom port. So once your invoice is transmitted to PFMS, PFMS will disburse your refund in your bank account. So any error relating to bank account will be found at PFMS stage. So we, at the time of filing GST returns, assume that as a GST return has been filed, refund will be credited to bank account. But no, such invoice is being traveled from custom authorities to GST and to IceGate to custom port to PFMS and then in your bank account. So that is very this flow should be in mind while uploading your returns or while verifying your shipping bills. Now, what could be the possible errors? Before that, I have kept some of the screenshot of GST and inquiry which shows the EGM has been filed, IGST validation status, which shows the list of response code and errors SB000, meaning thereby the particular shipping bill has been successfully validated, and the screenshot of the scroll has been generated, and invoice has been transmitted to PFMS, and POA, public account officer, has accepted, and bank amount has been credited to bank account. So now the list of errors. We'll quickly see the list of errors in 2 or 3 minutes, and then we'll spare some time for the question and answer. So SB001 to SB006, these errors pertains to in case of invalid shipping bill number you entered. The ISGate pops up with SB001. You can very well rectify such shipping bill details in your GSTR1 in table 9A. Now, as such, the rectification of details are as such restricted to next year's 30th November. But as far as the shipping bill details or port code details are concerned, that can be rectified even after such amendment date. Porter is very well allowed. Even you can rectify such details even today for 2020 or 21. SB002 EGM not filed. Just you need to intimate your custom agent that please let come to the know your shipper that your EGM still not been filed. Once EGM has been filed, the error code will be resolved and your refund will be disbursed. There are possibility that there are multiple error codes which can be found in IceGate portal. In case of GST and mismatch, you have filed shipping bill with one GST number, and you do have multiple state registration, and you have uploaded such invoices in another GST logins GSTR1. So this error will occur. One need to correct this error by uploading in the correct GST login. SB00 phone, meaning thereby once the record has already been received and refund has been processed, and again you have uploaded such invoice with the same shipping bill number, this error will occur. In case of invoice number error, you can SB005 error will occur, and you can very well correct such error in GSTR1. Gateway EGM is not available, SB006. This error is kind of EGM not filed only, and you need to contact your shipping lines to file the gateway EGM. Apart from that, TBE001, some of the errors are not solvable. Say if invoice number has been gone wrong in shipping bill, and as I have discussed, EGM, once EGM has been filed, your superintendent of customs may not be in position to make the online amendment in your shipping bill. He will definitely give you the amendment report if you request in writing, but he will amend it manually, only on letter. But the effect of such amendment will not go into the system. That's why these things are very crucial, even at the time of execution. Another errors TB001 to TB0025, that these errors pertains to issue with your bank account. You need to approach EDI section of so and so port along with your AD code letter of bank and other bank details, and the officer will definitely rectify such errors. Uh, uh, Apart from that, there can be error of SB009. SB009 and SB declared as without pay. Say if you want to opt for with payment of IGST, but by mistake shipping bill has mentioned your invoice IGST value as zero. In such cases, again, before filing of EGM, such shipping bill has to be amended, or you should amend your tax invoice and shift your invoice to the LUT method to make it in sync with your shipping bill. There are other issues which we have already discussed, that a computer even not tolerate the error of dash or slash or space. So one should be very cautious while uploading GSTR1. It should be in sync in toto with your shipping bill. In case of IGST amount shown paid lesser in GST return vis-a-vis shipping bill, the lower amount will be processed, and rest of the amount will be gone. So amount has been 3.1, which we have seen. There is one method of concordance table, wherein if you have done some mistake in shipping bill, then your superintendent of customs will address such issue by once you give your concordance table showing the correct details. But these things are being done at the fortnight only, which the government has not come up with fortnight of correction of such errors since 3 years. So currently, it's very difficult to amend such details once without such any drive of fortnight at each custom port. IGST amount, if IGST amount has been amounted to zero, it is always preferable to amend it before filing of AGM, or one may shift their invoice to LUT method. Now, recently, one one instruction has been issued, uh, which says that if any exporter has been flagged as a red flag, then all such automated refund are will be restricted, and your application will transfer to your local jurisdiction officer. This instruction is providing the procedure, and once dgram tagged any taxpayer as an exporter, once he will pass the refund claim to local jurisdiction officer, and it will be deemed to be the filing of RFD 01 application, and then local jurisdiction officer will process your refund application as if it has been filed by a taxpayer. Deficiency memo cannot be issued as such application has been filed automated by the system. However, the jurisdiction officer will issue show cause notice if everything, he may visit your premise, he may exercise other powers to satisfy himself with the red flags on your GST number. If everything found in sync, then he will definitely sanction the refund. Along with that, he will also send his feedback to the DGRAM that everything has been found smooth, and you may remove the red flag. The DGRAM will remove the red flag. So this was my time. Thank you for listening to me patiently. I would like to thank again the chairperson of the CP committee, Sri Purushottam Ji Khandelwal sir, for giving me opportunity to present my views on these two topics. I would love to interact with all of the participants. My contact details are being hosted here, and would love to discuss any of the queries. Thank you, CP committee and the whole CP committee and all the team for giving the opportunity. Thank you.
Thank you, sir. We have a few questions that have been forwarded. Like, can I seek refund of ITC reversed during adjudication due to the reason that GSTIN of my supplier got cancelled suo moto by GST authorities with effect from 1st July 2017? If yes, what will be the time limit and documents required?
See, first thing is, uh, in the entire GST law, there is no such restriction which compel you to reverse the ITC only solely on the ground that your supplier's registration got cancelled retrospectively, right? The things are being done by the state authorities extensively, but that is not as per the law. Now you have already reversed. If you reverse voluntarily under section 73 bracket 5 or 74 bracket 5, if you reverse the voluntarily, you must file for the refund. The refund will be definitely rejected by the your local jurisdiction officer, and you need to fight for that. With respect to time limit, since you have reversed it voluntarily, the case will be you should file for the refund, but you need to litigate for such issue, as your local jurisdiction officer will not entertain this refund application on the first stage.
Interesting. Next question is, we are paying IGST on exports adjusted against available ITC and then refund of the same is claimed. Are we eligible for inverted duty refund?
No, ma'am.
Okay.
Section 54 bracket 3, third proviso to section 54 bracket 3 restrict refund of unutilized ITC if you have chosen the route of with pay. So logically that should be allowed, as we have discussed in the session, that if your procurements are at higher rate and your final product falls in the classification of lower rate, and if you have chosen with payment of IGST method, technically the for the rest of the ITC, inverted duty should be allowed. But currently it has not been allowed. And in fact, the very basic purpose of this session is to uh, select the correct method. In your case, you should select now onwards LUT method, so that your amount working capital will not blocked in credit ledger.
Okay. Next question is, can I get financial year 17-18 the GST refund when export made with payment of IGST?
If you have export made under with payment of IGST for 17-18, you can definitely get. I'm assuming your application is being stuck at any of the error which we have discussed. You need to get yourself logged into the IceGate and see the errors. You can also get the Excel sheet hosted on each of the custom ports, wherein with respect to your IC number for each of the shipping bill, error is being hosted. You need to resolve that error, and if the error is resolvable, you can definitely get even refund even today for 1780.
Okay, sir. In case of export of services without payment of IGST under LUT, if export proceeds are realized after 1 year from invoice date, should we first pay tax with interest at 1 year end and then again apply for refund upon export proceeds are realized, or we are not eligible for refund at all?
So these things are being clarified by circular, which says that no adverse view should be taken if export proceeds are being received lately. And secondly, the in case of export of services, the refund itself linked to the receipt of your foreign convertible currency. So before receipt of such for convertible currency, you must not have taken any refund, right? So you need to apply for the refund as and when you get the proceeds, even if it's received lately. A circular is there which says no adverse view should be taken.
Okay. And sir, last question. What if I have not applied for LUT for financial year 22-23 and exported services without payment of IGST? Can I claim refund for the full year?
See, there is one circular which says if officer should not take it adversely if LUT has been uh, applied lately. So you should, since the year has been gone, even portal will not even allow you to apply for LUT lately now. So you need to file your LUT belatedly now manually. You need to file your RFD 11 now manually and apply for the refund with that manual LUT, and also attach that circular which says the adverse view should not be taken.
Thank you, sir.
Thank you.
Thank you for explaining everything so nicely, and thank you for the time.
Thank
Thank
you.
you, sir.
Thank you. Thank you, ma'am. Thank you.
I would like to continue the session with introducing our next speaker, CA Pushpendra Dikshit. He has an experience of 18 years in the area of direct and indirect taxation. He has worked on foreign projects like US GAAP, tax audit, FIN A48, ETR, and tax accounting for a US company. He has also delivered more than 50 sessions on tax matters on various platforms and has been a visiting faculty in various prestigious academies. Please welcome CA Pushpendra Dikshit. Sir, the stage is yours.
Good afternoon, CA Mega. Uh, Good afternoon, all the participants. Uh, Warm welcome to CA Purushottam Khandelwal ji, Chairman, and our beloved CA Gyanchand Mishra ji, Vice Chairman, CP Committee. Thank you for this opportunity to interact with such large participants on the very interesting issue. Taxation is not a new subject for any one of us. Nonetheless, the kind of technology revolution we are experiencing and the kind of digital economy we are passing through has made all the important to discuss digital economy taxation. Everything remains the same, but the way and means we started doing business has undergone a tremendous change. We've seen taxation models which are almost a century old. We have double taxation avoidance agreements, we have domestic tax laws, and we have a lot of learnings and judicial precedents, etc. But those all are things of the past. They are not totally applicable to the current realm of digital economy. They needs to be adjusted, they need to be revamped in line with the new business models, new ways of doing business, because business doesn't stop. we have to come out and understand the right business model to apply the right kind of taxation. My topic on digital economy is very pertinent to each and all, and this topic is very interesting in the sense that coming, as per my understanding, next 10 to 15 years is going to be talked about digital economy and its taxation. We have entered digital economy, but we are yet to fix various issues. Since I am delving into taxation, I'll revolve my discussion around taxation, but it is very important. As much as that each and every country across the globe, they are keen. Just to give you a perspective, OECD is a organization for economic cooperation and development, the international organization which is tasked to ensure proper and just taxation all across the globe, specifically for multinational enterprises, which are MNCs, also known as MNCs. So they are currently working on a project called BEPS and two pillar, OECD two pillar approach. Quite a few of you have heard also, which is nothing but trying to strike a balance between source of taxation and minimum taxation. So I'll dwell into it. I'll talk about it more and more as we progress into my slides. But I'm just giving a perspective just to arouse the curiosity among the participants as to how interesting topic is it, that what is digital economy. People also call it new economy, and also various intricacies like current set of tax laws, how we are passing through those, and how new tax laws are being introduced, which are quite often unilateral, because we are yet to reach a consensus among 141 nations which are part of this OECD thing. But out of 141, 137 have agreed that we all are concerned about the fair and just taxation. Any country which is earning any income from our side, from our source, from our database, it should be paying tax to us. So that is the ask. So we'll dwell into it. Mega, just help me understand if my slide is visible. Let me just put it up. So is it visible?
Yes, sir, it's visible.
Oh, very good. So let's understand digital economy and its speed and the coverage. Digital economy, we all know, we talked about it, that it is okay. Sorry, just a
So
minute.
try pressing F5.
Just a minute. F5.
Yes, sir.
Control F. Just a minute. I'm doing function F5, but it's not working. Just a minute. No. Just a minute. Is it better? Okay. Just a minute. Is it visible? Okay. Yeah. Uh, just a minute. क्या फंक्शन बोला था? Control. Okay. Let's continue. Yeah. So I said digital economy has a very unique feature that it is no longer confined to a particular territory. It is borderless, and that is one of the strong point of it, as well as a weak point, where everyone which is a different country other than one border, sovereign countries, they are concerned that one person who is staying in US but earning from India, they should pay their fair share of tax in India. Is what digital economy is having big question right now. It is estimated that more than 70% businesses will switch to digital modes, and digital economy will grow close to USD 200 billion by 2026. We have seen that even pandemic time also it did not stop. Instead, it increased, and I think Zoom meeting or Google Meet, they all are contribution, if any, during pandemic. To my mind, we were missing on it, I would say. The existing brick and mortar business model, which is the physical laws, like you enter a particular country, then there are days, there are limitations in terms of number of days you stay in a particular country. Or the existing business model, we also technically call it brick and mortar. The existing business model, which is based on physical business presence, are vanishing because of the digital economy presence. And it raises a concern for us to step up and understand how digital economy needs to be taxed. I already mentioned that OECD is under a task to make sure this accrual of income and minimum taxation both are well taken care of at global level. And for that, 141 out of 137 out of 141 countries, they have agreed. So let us just understand some of the open issues and existing way the tax is being occurred. At the moment, we have two law, taxation models. One is OECD tax model, and another is UN tax model. OECD tax model is basically supported by developed economies, US, UK, and which essentially believes that taxation should be based on residence based, while UN tax model is supported by developing economies, you can say Southeast Asia, India, and other countries, which basically relies on the concept of accrual of income or taxation on the basis of accrual status, not the residence. We have seen a journey and the concept how business connection has evolved. Our Income Tax Act, Section 9, is very comprehensive, and it takes care of every situation how income, non-resident business income, can be taxed into India. For that, we check whether it is a business connection. For that, we see if he has got a permanent establishment in India. We also check whether it is business or even the passive income in the form of royalty, in the form of dividend, or technical fee. So that it is the current state of affairs. And DTAA machinery is based to make sure that a taxpayer gets the best of both the worlds. If there is a transaction which is happening between India and US, then the taxation, then the assessee should get the best tax treatment between the two. That is also enshrined in our domestic tax law. Section 90 talks about that whichever is beneficial to a assessee should take the position. Permanent establishment concept is there in the Income Tax Act, and also in the treaties with which India has agreed. And permanent establishment talks about mainly about the number of days stay in India, or the kind of branch or PE or some other ways you are showing a permanence in India to earn an income. But as we will proceed further, we will understand how this permanent establishment concept needs to be evolved, and what Indian government has done so far in this connection, and how international arena is working on it. We'll talk about it as we proceed further. Well, the concept of copyright and copy of copyright is another interesting topic that recently was dealt by Supreme Court in the case of Engineering Analysis Center of Excellence, where Supreme Court categorically mentioned that a copyright or a copy of copyright, they are not one and the same. While copyright is a license, but copy of a copyright may not be a license. So you have to treat them and subject the taxation accordingly. Deeming fiction, I talked about that existing tax principle, they have the deeming fiction. What do I mean by deeming fiction is, while business income, we talked about that in order a non-resident to become taxable in India, he has to have a business connection in India. But in respect of non-business income, for example, royalty, fee for technical service, dividend and interest, you need not to, I mean that non-resident need not to have a place of business in India. He can be taxed in India even based on the source of income. And that is where we see any and every payment which we make out of India to non-resident in respect of dividend, royalty, fee for technical service, we always subject it to TDS, and the other party takes credit of it in their return of income. Just a minute. Just a minute. It's not moving. Sorry about that. Yeah. Megha, I'm so sorry about this technical glitch. Am I, shown on the next slide? India solo sprint. Okay, my
Yes, sir.
apologies. I don't know what is happening in this technical side. Yeah. So I mentioned you about the previous side that current system. Basically, what I was wanting to tell you is that while we have entered into digital economy and we are trying to understand and find ways and means to fix it, taxation cannot stop. And until we reach a consensus globally, um, various government they are started taking unilateral measures, and India has taken the first stride in that direction, and it went ahead and legislated various unilateral measures in the Domestic Income Tax Act 1961 to make sure digital economy or transactions emanating through digital economy are taxed in India at least, and I'm going to talk about those unilateral steps into this slide for your benefit. So, background I mentioned you. So, India levied this equalization levy in the year 2016, and this was also popularly known with the name of Google tax. That any company which is not a resident in India, let's say Google Singapore, it is running an ad for Indian company and earning an income from India, saying that it does not have a place of business in India, it does not have a P in India, therefore there is no business connection. It can run away from taxation of the income which has sourced from the India. To make sure that these kind of situations or tax leakages are plugged, India introduced unilateral measure of equalization levy in the year 2016 itself. Although equalization levy is not part of the Income Tax Act, it is part of the Finance Act 1994. But idea was just to make sure that we do not have open loopholes of not getting tax share in respect of income which is being earned by a non-resident from India or from a source in India. So that was very bold step at that point in time. uh, Next step was a significant economic presence. Participant may appreciate that SEP concept got introduced in the Income Tax Act 1961 in the year 2018, and it is such a wide and comprehensive concept that it is 10x of permanent establishment, I would say. Permanent establishment, the concept existing only talks about that, let's say if you have a 90 days presence in India, or let's say you have 180 days of presence of India depending upon the treaty, then only you will be considered to have a business connection in India. But SEP does not talk about this. SEP is in line with the future of future digital economy or future of taxation. It takes into account, all digital economy transactions, regardless of physical presence. We'll talk about more once I, get into SEP specific slide. Point number three, equalization levy 2.0. Besides introduction of equalization levy 1, which was specifically for the advertisement, equalization levy 2 was contemplated, that what about sale and purchase of goods or services by a non-resident to Indian customer. We have talked about the online advertisement or provision of digital advertisement, which is captured by equalization levy 1 at the rate of 6%. But what about sale of goods and services by non-resident in India? How to capture those? Because unless that non-resident has a business connection in India, Indian tax frame or the domestic tax treaty cannot be applied to tax or make him pay tax in that income in India. And therefore, Equalization Levy 2.0 got introduced, and it is applicable on online sale of goods and services, and 2% on gross value is applicable. I have captured it little more in detail as we proceed. I'm just giving a perspective as to what bold steps India has already taken as we are speaking, and what more needs to be done. Fourth step is Section 194O, which got introduced in Income Tax Act, which was specifically to make sure this e-commerce operation, e-commerce operators, each and every transaction through e-commerce operator or aggregators, that is also now subjected to TDS at the rate of 1%. I have captured couple of instances of IGST also, uh, which is OIDAR services. Basically, if you are consuming some services which are in the nature of online information database and access, GST law mandates you to take a registration in India. So, from indirect tax perspective, also there are significant steps which the Indian government has taken, and OIDAR is one of such provision where a non-resident providing online services is required to take registration in India regardless of his presence in India. And TCS under Section 52 under GST is again one such concept for e-commerce operator under GST law. So just to give you a complete flavor of it, that Indian government is very far ahead in terms of taking unilateral measures, because India is inevitable in terms of two form. Number one, India is the great economy in terms of consumption, but India is also a great economy in terms of possibility of new industries, opportunities, manufacturing, services. So India is two-way helpful to the world. It is a largest consumer market. At the same time, it is largest place to provide services and things. Just a minute. No, leave it. Yeah. This slide I have captured specifically for talking about special economic presence. This is actually a very comprehensive concept. I purposely included it in my slide. So just to give you the kind of language which is there in the law, that significant economic presence is term which includes income taxable in India, irrespective of the fact whether the agreement for such transaction or activity is entered in India. Non-resident has a residence or place of business in India, or a non-resident renders services in India. So SEP is a very wide concept. It has got nothing to do with the physical presence, but the actual substance. Now, there are some criteria which were established to make sure how SEP will kick in. They say that aggregate of payments arising from transactions in respect of any goods or services or property carried out by a non-resident with any resident, including provisioning of downloading of data or software in India during the financial year if it exceeds 2 crore rupees, which is 2 million, 20 million INR, equivalent to 2 crore in a financial year. If the transaction value exceeds 2 crore rupees, then there will be applicable of two, then the SEP concept will come in. And SEP concept means that that particular non-resident has a place or business connection in India. So that will take us to little closer to a permanent establishment concept, and then highest 43% tax rate, total income less deduction of that PE, those kind of things. But even for a person who is a non-resident, who does not have a place in India, who did not have any agreement entered into India, still if his turnover exceeds 20 crore in respect of those things, or moreover, just see the next line, systematic and continuous soliciting of business activities, or engaged in interaction with 300,000 or more number of users in India. So just see the beauty of this concept. They are saying that if there is a systematic and continuous soliciting of business activities, even then will be construed as a significant economic presence. While systematic and continuous is a very wide term, one needs to see how we can define it or apply it. But I'm saying, just I want to draw your attention to the comprehensiveness of the concept which Indian government has introduced, far ahead of PE concept. So SEP provisions were deferred to 22-23, and then equalization levy provision will expanded, that we already talked about. But India, is already far ahead and making sure that they are step in step with the OECD to go ahead with the OECD model, or two pillar approach model, as it unfolds in future. We'll find. यार क्या प्रॉब्लम हो रही है मेरा I'm constantly having the same issue यार sorry I'll have to
No issue, sir. No problem.
disconnect and again connect. My apologies. My apologies. Okay. Continuing with the same advertisement targets data that we talked about in detail. Idea was just to give you a perspective. Like in existing Income Tax Act, we have got enough coverage of this digital economy. A non-resident, just imagine a non-resident who is sitting in Canada or USA is soliciting business in India. Users are 300 or more, 300,000 or more, or transaction exceeds to 20 million INR. So technically speaking, he is having a business connection in India. How and when or which way government of India can trigger, administer, bring tax, etc., that is administrative and other things. But I just want to draw attention of the participants and members that this kind of comprehensive tax is already legislated in income tax law. TDS on e-commerce, we already talked about that. E-commerce operator, it was the first time that even goods which are sold through e-commerce other than services, so they were also captured. TDS rate will be 5% if PAN is not available. All those things are there. But the very purpose of including this is in respect of digital economy, that what all steps India took in advance to make sure that online transactions are having a decent track. Government of India is having detail of each and every online transaction so that it can subject it to appropriate tax. So that was the reason for including it. Equalization levy we spoke about, that one was specifically for online advertisement and digital advertisement space, which was also known as Google tax, applicable at the rate of 6%. The other one, which was introduced later, was more comprehensive, which was including supply of goods or services also, and it was applicable at the rate of 2%. Few important pointers on this which worth mention was that equalization levy was outside the ambit of Income Tax Act, because it was contemplated in Income Finance Act 1994. And that clarity was given in the law that if a particular transaction is suffering equalization levy, income TDS will not apply on that. So either of the two will happen, right? Non-resident who is having P in India, then domestic provision will prevail. Equalization levy is applicable only when a non-resident who does not have a place of business in India. So if somebody who is a non-resident has a place of business in India, then Indian government will have all the details, or otherwise, we have permanent establishment route to capture them. So equalization levy was basically for those who do not have any place in India but still sourcing income from India. Yeah. So equalization levy had some exceptions also that I will like to draw attention that equalization levy applies only with respect to online provision of goods or services, which we talked about, sale of advertisement or person. So the idea of including this was that it says that sale of data collected from a person who is resident in India or a person who uses an IP address located in India will also be you know covered, right? And while a person who does not who has a place of business in India, that he will be subjected as per the permanent establishment. EL is only for those who do not have a place of business in India. Well, this one is little news concept for participants, and it is an evolving concept of OECD two pillar approach, and very topical issue nowadays. And OECD is working hard, including all the members, to include these two pillars into tax treaty or the domestic tax, one way or the other, through MLCs, to make sure that income is taxed on the base of sources, and where regardless of the place where you work or where you operate your business, you have to end up paying 15% tax on your income. These are the two big asks out of these two pillars. So let's understand those pillars one by one. So pillar one basically talks about reallocating taxing rights. So pillar one talks about fair allocation of profits and taxing rights among countries, i.e., the home country as well as the user countries where you are having nexus in terms of income earning. I'll go a little slow because this is a little complex compared to others. Basically, it talks about a threshold that pillar one of OECD will only apply in case the global turnover of that multinational is exceeding 20 billion euro. That is too high, and it is expected that euro 20 billion will reduce to euro 10 billion after 7 years of pillar one effective implementation. But right now it is euro 20 billion, and they are saying 25% of profit, which is about 10% of routine profit, will be subjected to reallocation of taxing rights. And they have also captured amount A, amount B. So I'll not get into more technicalities, but I'll just draw attention of the participants that there are two components, amount A and amount B, which are adjustments in case of pillar one, to make sure that a non-resident who is earning income from India has to pay tax to Indian government in two ways. Number one, if he has sourced some income from India, then the income which is sourced from India, in respect of that turnover, he has to pay tax in respect of that turnover in India. That is point number one. Point number two is that baseline or return for marketing and distribution functions. So that is a concept, a little connected with transfer pricing. Transfer pricing has a arm's length concept, which says that if a particular company is earning a income or a revenue or a profitability, it has to be linked with the function, assets and risk, FAR. Based on your functions, your assets employed and your risk taken, you are eligible to a particular return. So amount to B is basically if a particular company who is doing sales and marketing distribution function, then it should have 3 to 5% return, not more than that. So amount B is basically a little connected with transfer pricing, while amount A is clear that if you are having a source in a country, you have to pay tax in respect of the income which is sourced from that country. By adding these two amounts, it is ensured that proper tax, at least 100 billion US dollar tax, will be fairly reallocated. That is pillar one, and this pillar one is very much aligned with the approach which India had been advocating since day one, the UN tax model, which was always relying on the accrual basis of income. Wherever you do activity, wherever you are earning income from, you have to pay the due share of tax in that jurisdiction, regardless of your place of residence. That was the day one position in UN tax model, and this has been finally enshrined by the OECD also, which was not agreeing to this hitherto, but now they have accepted it. Nonetheless, the threshold has been kept little higher, 20 billion euro, which to my mind will get adjusted once there is an agreement. We'll see in the course of time. An idea behind having this pillar one is certainty. Through effective dispute prevention and resolution, OECD expects that they will be able to reallocate the taxing rights to those jurisdictions and markets which have contributed to the earning of income of that non-resident. He cannot just run away by earning income in a particular country. He'll have to pay due share of tax also. That is all about pillar 1. I'll take up any specific questions, but let's move to pillar 2. Pillar 2 is basically ensuring a minimum corporate tax. We were listening, we have grown listening, tax planning, or these no zero tax country, Bermuda and Cayman Island, and so on and so forth. But now, in the days of digital economy, those are things of the past. We have to be fair, we have to be transparent, regardless of the place we operate from. Now, location is no more a concern. You can be distantly located, but you can be available as much as that all participants are interacting with each other on real time basis. So that is the power of technology or digital economy. So now location is not a concern. What is important is the income and the source and the right share of tax, and that is the main ask. And this particular project is intended to enshrined into tax laws through tax treaties also, some piece through domestic laws, some piece through tax treaty, to make sure that this actually starts working. Pillar 2 is having a threshold of 750 million euro, and it requires that in case a particular multinational corporation is having a turnover of 750 euro million, it has to comply with pillar 2. It is of course it is not compulsory, but it is instruction mandatory, in the sense that each government has to incorporate those instructions in their tax law, because that's how the whole economy will work. We will have to work together. We cannot be just saying that we will not imbibe pillar 2 or any instructions, because it is going to impact each one of us. So if the turnover is exceeding 750 euro million, then pillar 2 is applicable. And the ask of pillar 2 is that regardless of the place you operate from, 15% is the minimum tax you have to pay to the government of that particular country. If it is more than 15, it does not apply. If it is 10, then 15 minus 10, 5 you have to pay. If it is 5, then 15 minus 5, 10% you have to pay, like that. So pillar 2 consists of 4 globe rules: income inclusion rules, under tax payment rules, subject to tax rules, switchover rules. I'll spend 1 minute more on those points. These are new topic. They are technical bit. We'll familiarize ourselves as we'll talk more and more about it. But these are important and these cannot be avoided. That's why it is important for us to understand it. So IRR and UTPR, will discuss more in following slide about it, but these are expected to be included in the domestic tax laws of the countries. Each country of the world will include those income inclusion rules and UTPR rules under paid tax and under tax payment rule. So basically, what IRR and UTPR talks about is that you have to make sure that accrual basis income. If your domestic tax law also talks about that any country, regardless of the place of residence, if it is earning income from India, it has to pay share tax of India, fair share of tax in India. So IRR is all about that. So that power should come from the domestic law. Likewise, UTPR is under tax payment. If a payment which is under tax, then you have to have right to tax the top up tax, right? Likewise, STTR and SOR, subject to tax rule and switchover rule, they are basically transfer pricing concepts. which I will talk about, and they will be imbibed through the tax treaty. Uh, Globe rules do not compel any country to adopt a minimum tax rate. It is just a recommendatory. But if source country doesn't levy minimum tax, then the other jurisdiction would have right to tax. So that is very important. I repeat it. The Globe rules, the Pillar 2, Globe rules do not compel any country to adopt a minimum tax rate that you make your minimum corporate tax rate to 15% as per domestic law. No. However, if a source country does not levy minimum tax in that particular country where income has been earned, and it falls short of 15%, then the other country, the jurisdiction, will have right to tax the difference amount. Is the ask of this. Excuse me. So by these two pillars, a balance will be struck. It would help in avoiding double taxation and levy of tax where there is a source of economic and profit. Yeah. So a little bit more about those globe rules. Income inclusion rule is basically similar to CFC rules, controlled financial corporation rules. So it is basically a top-up tax in case that parent entity, if constituent entity is in low tax jurisdiction. So what does it mean is that in case a company which is outbound, which is having a presence in India, because the pillar 2 will not apply in case of India, it will apply to a company which are outbound. Indian headquartered company is based out of other countries, because India anyways has 25%, 30% tax rate, so 15% out of question. But if you were to think about that how this pillar 2 will apply, it will apply for those companies which are outbound, Indian headquartered but present in other countries. Okay. So CFC rule is they are just telling that how IRR is similar to a CFC rule. If the jurisdiction entity or the constituent entity is in a low tax jurisdiction, then the differential tax will be applicable on the parent entity, is how they say. Under tax payment is basically a fallback rule. If IRR does not apply, then jurisdiction will have the right that parent entity jurisdiction does not apply IRR, then the under tax payment of the company will happen through a adjustment, that under tax income of companies under the group level, they have to disallow the deduction to make sure that proper tax is paid. So it's a fallback rule. If IRR is working, then there is no need for UTPR. STTR is again a transfer pricing point related to related party transactions. Let's say a related party transaction is subjected to have a tax rate, tax withholding rate, let's say 9%. Right now, range is 7.5 to 9. If it is tax applied at the rate of 5% tax withholding, we make a lot of related party payments in MNC environment. So if tax withholding is below 7.5 to 9, then tax treaty in future will have a provision to make sure that additional withholding is applicable on that. Switchover rule is again uh, basically contemplated to make sure that if there is any conflict between domestic provisions or the tax treaty provisions, which we just talked about, IRR and STTR, then switchover rule will help which particular thing will apply in absence. So that will help in that. So, couple of points which are important for us to understand that while we have a century old law, tax law, 1861 to 1961, and still it is going on. Do we need a brand new tax law, or we just need to make some adjustments in the rules and tax models, depending upon the particular industry and thing? Because income is tax is always applied on income, not on the gross. So better we understand the model, better we understand the nature of income to apply the tax. Transfer pricing rules to OECD pillar 2 approach. uh, how the entire chain will work. We have 141 members, out of which 137 have agreed, and even after agreement we need to see those rules and laws included in our domestic tax, included through our tax treaties, but how those will be administered will be a big question. So one immediate parallel which I can draw through it is that India has seen GST implementation. We have 28 states and then union territories also 7. How this state and central tax legislation is working under the aegis of GST Council. I think something of this sort India can be a reference point to the world on this OECD level also, that if India can work on this GST Council and state and central body coherently, why can't we can have a common body at global level represented through each sovereign nation, and we can work together to make sure that we reach a common consensus and make this world as one market and really transparent. That is it, Megha, from my side. The floor is open for the participants to ask questions. My apologies for technical glitch. I was toggling between the slides because of technical glitch. My apologies for that.
Thank you, sir. Thank you for explaining it so well. And significant economic presence, something I am also researching upon. There are some recent amendments which are leading to applicability of TDS on significant economic presence. That's
Correct.
what I was trying to understand. But I would like to have the number also, sir, if it's okay.
Sure, definitely.
Sir, please can you show the PDF? It's very nice, like a PPT. Very nice, actually. I would like to go through it again.
Yes, I will share it.
Okay.
So,
Thank you, sir.
just check with the participant if they have any question. Although the topic is little complex, but
Yes,
it is
sir.
very pertinent. I'm telling next 10 years, 15 years, we will only talk about the digital economy. And
Mm.
interestingly, I'm working on a book also, digital economy
Oh,
taxation. So
nice,
that's
sir.
where it's an area of my interest, and I just speak my mind on that. So that is the area.
Sir, I have some questions. What is the TDS implication in due to a significant economic presence concept? We need to deduct TDS. Vendor from which we are importing goods are from UK. What documents we would need?
You'll have to repeat question, Mega, for me.
Sir,
Importing goods.
so it's a what is the TDS implication in case we need to deduct in case the vendor from whom they are importing the goods is from UK. So
Mhm.
and what documents will we need?
So first of all, income is taxed. Import of goods does not require any TDS provisions, even in current state of things. But if you really want to make it hyper technical, Mega, and for your information and understanding, SCP concept as such even gets triggered even in case of the threshold of 2 crore or 20 million INR breaches for import of goods also,
Hmm.
technically speaking, right? So it is better to keep the documents such as no p TRC and all those things, making sure that they do not have business connection here, etc., to have some respite, to have some saving for any tax query later on. Practically nobody bothers because this concept is very technical. Practically how it will be implemented, that we need to see. But hyper technical, the way the law is, even you import goods worth rupees 2 crore or more, then one of the threshold of 20 million euro, 20 million INR gets breached. तो business connection तो बन जाता है.
Hmm. Yes, sir.
But practically, you just need to take the documents such as no PE, TRC, etc., and you can be relaxed.
Okay, sir. The next question is, when does EL1 acquisition levy 1 apply versus EL2? Is EL1 even applicable now?
Yes, that is very good question. That is when number one, EL1 and EL2 both are applicable. EL1, which is also known as Google Tax, is basically for advertisement, online advertisement income, or online marketing, etc. While EL2 is basically at the rate of 2%, it is basically for other than advertisement, import of services, import of goods. It is from the supplier side, a non-resident who does not have a place in India. Amazon, let's say hypothetically, Amazon US कैलिफोर्निया में बैठा हुआ है, इंडिया में उसकी कोई कंपनी नहीं है जिस कंपनी से सप्लाई कर रहा है, एंड दे आर सेलिंग गुड्स और सर्विसेज टू अस इन इंडियन रेजिडेंट. तो EL2 will applicable on that Amazon. बट प्रैक्टिकली Amazon खरीदने वाले को ही बोल रहा है तुम्हें ही देना पड़ेगा, इसका कॉस्ट को हम जमा करा देंगे एंड ऑल, दोज आर द डिफरेंट थिंग्स. But the way law stands, equalization levy is payable by the Amazon in respect of the sale, 2% of that value if it exceeds 20 million or 2 crore rupees, जो जनरली हो जाता है इन लोगों का. And both are
Okay.
applicable as on today. Equalization levy is not a concept of income tax. फाइनेंस एक्ट 1994 से उसको बनाया है. दे आर एप्लीकेबल पैरेलली. लेकिन अगर टीडीएस आप लगा रहे हो किसी ट्रांजेक्शन पे, तो इक्वलाइजेशन लेवी लगाने की आपको जरूरत नहीं है, राइट?
Hmm.
आपको दोनों में
Yes,
से
sir.
एक लगाना है. टेक्निकली टीडीएस लगाते हो तो सामने वाले को क्रेडिट भी मिल जाता है. इक्वलाइजेशन लेवी के कंसर्न है क्रेडिट मिलने के नहीं मिलने के. और हम आगे देखेंगे कि जब ओईसीडी आ जाएगा तो यूनिलेटरल मेजर्स जो इंडिया ने लगाए हैं, इक्वलाइजेशन लेवी 1 2 एटसेट्रा, दे आर एक्सपेक्टेड टू फेड अवे. वो होंगे नहीं होंगे,
Hmm.
टाइम विल टेल. बट बोथ आर एग्जिस्टेंट एज ऑन टुडे.
Okay. Thank you, sir. Thank you so much, sir, for your time and patience.
Yeah. We have any more questions, Megha?
No, sir.
I can't hear you.
No, sir.
Okay. So we are good to go.
Okay. Yes, sir.
Thank you. Thank you very much for the
Thank you,
patient.
sir.
And I believe the participant would, understand or appreciate. I try to make it as simple as possible, but the topic is little technical.
Yes. Yes, sir.
But
Thank you, sir.
it is close to my heart. Yeah. Thank you very much, everyone.
Thank you, sir.
Yeah.
Bye, sir.
Yeah. Bye.